A 13% coverage ratio, 550 million ounces paper, 78 million ounces real metal. Those numbers cannot coexist forever. OG John AG here. Drop OG John AG in the comments if you are here paying attention and actually learning. Now, the coverage ratio just broke below stress thresholds again. Let's get straight into it. There is one number dominating this entire market right now, 13%. That is the COMEX silver coverage ratio today. That means only 13% of claims are deliverable immediately. The rest depends on behavior assumptions holding. The data is doing the talking. Think about what that sequence actually means. Before we go further, if this kind of data-first analysis is what you have been looking for, hit the like button right now. Subscribe to OG John AG 1.0 and share this with one person who needs to see these numbers. Now, back to the data. Lead story today, COMEX silver warehouse data, 550 to 575 million ounces open interest, 77 to 80 million ounces registered inventory. That implies roughly 7-to-1 leverage. Effective right now. This follows a 6-month stretch below the 15% threshold. The exchange defines 15% as stress. We are below that level continuously. The unusual detail is persistence, not a spike, not a one-day event. 6 consecutive months below threshold. The timing is what deserves scrutiny, not the event itself, the timing. In January 2026, 33 million ounces were withdrawn in 1 week. That equals 26% of registered inventory. The inventory never fully recovered after that event. That is not coincidence. That is a pattern. Registered supply remains structurally lower since that withdrawal. Delivery capacity remains constrained relative to claims. What happens if delivery demand rises suddenly from here? What happens if just 20% stand for delivery? The ones paying attention already know what to watch next. Before I show you the full data picture, consider this. The last time coverage ratios approached these levels, volatility expanded sharply. The data is already telling you something. Let's build it out. Now let's build the full picture because COMEX does not exist in isolation. CME Group warehouse reports have dropped. 78 million ounces registered reported by CME Group. Open interest data from COMEX futures shows 550 million ounces equivalent. That gap defines the leverage. That gap defines the risk. LBMA Vault data shows broader inventory but not deliverable on COMEX. Shanghai Futures Exchange shows rising premiums simultaneously. Shanghai spot trades at $81 equivalent. COMEX spot trades at $72. That is a 937 premium. That equals 12.92% divergence. 6-month average premium sits at 768. Arbitrage is not closing that gap. The rate of divergence is not slowing. It is persisting. That is the key detail. The data is doing the talking. The ones who have been called alarmist for saying physical matters, they are not saying much right now. The ones who verify do not argue about it. And here is what makes that picture even harder to ignore. 7-to-1 leverage on paper versus registered inventory. 6 consecutive months below stress threshold. At the same time, delivery demand has not yet surged system-wide. That is not a contradiction. That is the setup. And before anyone takes that as a green light, timing remains uncertain. Setups can take a long time to resolve. Structural imbalances do not trigger instantly. What this tells you is the structural picture. The timing is a completely separate question. Anyone who claims to know the timing is selling something. Sit with that. Here is the number most people are not talking about. $110 oil. Brent crude moves 5% in one session. Now Strait of Hormuz escalation, because this is no longer a backdrop, it is the primary variable. 21 million barrels per day move through that strait. That equals roughly 20% of global oil flows. Brent crude jumps 5% on May 4. Inflation expectations rise immediately with that move. U.S. 10-year yields sit at 4.44%. The DXY holds near 98. The Federal Reserve holds rates steady with internal dissent. Barclays forecasts 0 cuts in 2026. That creates a compression environment for metals. Higher yields suppress non-yielding assets. Strong dollar pressures commodity pricing, but physical silver premiums are rising anyway. That is the tension. Markets are still pricing stable supply assumptions. Look at Shanghai premiums and tell me that holds. When markets start pricing energy-driven inflation reality, silver reprices higher structurally. Gold reprices first historically. Silver follows with higher beta moves. Every time energy shocks persist, metals eventually reprice upward. It has not been different yet. Think about what that sequence actually means. Silver Western spot at $72. Shanghai physical equivalent at $81. $9.37 premium. Short-term picture remains unclear. The structural picture remains tight. The macro environment suppresses immediate breakout. Key level remains $75 on COMEX futures. If $75 breaks with volume, upside acceleration follows quickly. If $68 fails, downside liquidity sweep occurs first. That is the only short-term read that matters right now. As for trading it, I cannot see a clean picture on the lower time frames right now. I cannot tell you what silver does tomorrow. Nobody can. If you think you know, good for you. The current environment remains conflicted and compressed. Sidelines is not weakness in this environment. It is the only edge there is. I have called this market both directions. I will call it again when I see it clearly. Right now, I do not see it clearly. The tape decides, not me. Here is the honest truth. Both sides of this trade have a real case, and the one you ignore is the one that costs you. So let's run both. The bear case is real. DXY holds near 98 supporting dollar strength. US 10-year yields at 4.44% pressure metals valuations. Fed policy remains restrictive with no cuts expected in 2026. The bull case is equally real. COMEX coverage ratio sits at 13% below stress threshold. Shanghai premium holds at 937 above Western price. January withdrawal removed 33 million ounces, permanently tightening supply. Size correctly. Know what you are in before you are in it. The physical market already knows where this is going. The paper market is still arguing. That argument does not last forever. Everything shown today points to one conclusion. Structural pressure is already built into this market. The only variable is timing resolution. Don't take my word for it. Verify every number I gave you today. Check the data yourself. CME Group warehouse reports, COMEX futures open interest data, Shanghai Futures Exchange pricing data, logic over hype, always. If this analysis added value, like this video right now. Subscribe to OG John AG 1.0 so you never miss a data drop. Share this with one person who needs to see these numbers. The ones running the OG John AG 1.0 playbook do not wait for the mainstream to catch up. They already know. OG John AG 1.0. Out.